Imagine you could have an ETF that only picks the strongest 100 companies of the S&P 500 and rebalances them twice a year to make sure that you always have the best of the best. I know it sounds crazy, but it's possible, and this ETF we're going to talk about today outperformed even our favorite growth ETF QQQ in the last 12 months with a total return of 40.11% against 28.94% of QQQ and 21.86% of the S&P 500. In fact, today we're going to compare this ETF exactly to QQQ and SPY to show you the advantages and disadvantages of today's ETF compared to the growth giant and the legendary S&P 500. My name is Rick, everyone. If you're new here, say something nice in the comment section and don't forget to subscribe to the channel to join this beautiful investing community. And now let's get right to the ETF, which honestly is an ETF that I wanted to do a video about for a while now, and last week a viewer called Gary mentioned it in a comment, so I decided it was time to get to work. Now, before revealing you the ETF, I want to talk about its strategy. The ETF is a momentum fund, which is an investment fund that invests in companies based on current trends such as earnings or price movements. Momentum is one of the most powerful effects in financial markets. It's the idea that stocks that have performed well recently tend to continue performing well, at least for a little while longer. So how does it work? Imagine two ETFs. One has been crushing it for the last 12 months and the other dead flat. Momentum investing says, go with the winner. Not because it's overvalued, not because it's cool, but because strength tend to breed more strength. But the problem is, as you can imagine, momentum fades. It's not forever. That's why momentum strategies must be dynamic. They need to constantly rebalance. And that's why this ETF is very interesting and it's built entirely around this concept. But now it's time to reveal the ETF. So today's fund is the Invesco S&P 500 Momentum ETF, ticker SPMO. This ETF has a Morningstar rating of 5 stars and a low expense ratio of 0.13%, which is indeed low considering that the ETF has only 11 billions in assets under management against 362 billions for QQQ and 655 billions for an S&P 500 ETF like SPY. Looking at the prospectus of the ETF, you see that the fund's momentum score, namely how they pick the companies within the S&P 500 index, is based on price movements and volatility. So first, the index evaluates how the stock price moved in the past 12 months and then adjusts it based on volatility. So let's start now the comparison of the three ETFs, SPMO, QQQ, and SPY, starting from the main information and quickly moving to what investors always seek the most. Performance. The Invesco S&P 500 Momentum ETF has 11 billions in assets under management, tracks the S&P 500 Momentum Index, and contains 100 holdings taken from the pot of the S&P 500. QQQ is also from Invesco and manages $362 billion, including also around 100 companies. The S&P 500 doesn't need any presentation. The one I use today is SPY from State Street and manages $655 billion with 500 companies in it. For reference, the biggest S&P 500 ETF, which is VO, manages $682 billion. Now, let's move to performance, starting from the performance in the last 12 months. I find it quite impressive because SPMO, compared to QQQ and the S&P 500, crushed it in the past 12 months, delivering 40% in one single year against roughly 29% of QQQ and 22% of SPY. And if we move to the performance of the past few years, SPMO keeps overperforming. In fact, in the past 3 years, SPMO delivered 29% per year against 22% of QQQ and 17% of the S&P 500. Now, here's where things get interesting, because obviously just looking at the return of the past 3 to 5 years can be misleading. We must always remember that a momentum ETF has the strongest overperformance compared to others in moments of strong market concentration, but doesn't have a great performance when the market is better distributed. So for example, in the past few years, we've seen companies like Nvidia or Meta jump to the moon, so a momentum ETF that only picks these companies is going to show a wonderful performance. So let's try to zoom out and see how SPMO, QQQ, and SPY performed over the last decade. And by the way, SPMO is about 10 years old since it was founded in September 2015. So looking at the last 10 years, the ETFs had a really interesting development. In fact, if we just focus on the total numbers, in 10 years, QQQ would have turned a $10,000 investment into $54,000, while SPMO, $50,000, and the S&P 500, $36,000. But if we look at the different phases, we notice that between 2020 and 2022, so after COVID hit, QQQ had a much better performance, but also crashed the most in 2022. getting to almost the same value as SPMO. This shows a lower volatility in SPMO compared to the growth giant. After 2023, you see that at first, QQQ grew faster, but SPMO kind of picked up quickly. If we put the results in a table, you see that QQQ had actually a higher annualized return in the past 10 years with 19.3% compared to 18.4% of SPMO. Even though the maximum drawdown, namely the most the ETF has lost in a bear market, was a whopping minus 32% for QQQ and only minus 21% for SPMO. So this shows us two things. Number one, QQQ showed a stronger long-term performance, and we shouldn't be blinded by the fact that SPMO overperformed in the past couple of years. Number two, the momentum ETF SPMO tends to have a lower volatility than QQQ. Namely, in case of a crash, we can expect our portfolio to drop less than with QQQ. The truth is not black and white though, and when looking at performance, we always need to consider the dynamics that played along in the last 10 years. For example, SPMO did have a lower volatility, but it's also true that we've seen the biggest companies like Nvidia and Meta gain so much in the past years. And during the crash of 2022, when everybody was expecting all these huge overvalued companies to crash, they were actually holding up much stronger than the undervalued mid and small cap market. So this obviously gave an advantage to momentum ETFs like SPMO. Now I want to show you how the holdings and sectors are distributed in SPMO compared to QQQ, and in this I have to admit that SPMO is strongly superior. Let's start with QQQ. QQQ has 11% in mid cap, 88% in large cap, and the stronger sector is technology, with over 52% of the holdings being in technology. This is something I don't consider great, considering that an overconcentration on one sector brings a lot of volatility with it. And also that technology in particular has an incredibly high price-to-earnings ratio, which grew incredibly in the past 15 years. Moving to SPMO, you see that here the sectors are wonderfully distributed, with a light overweight in technology with 23%, followed by financials, consumer discretionary, communications, and as you can see, all sectors are represented here with a decent weight. You can see how this helps a lot to reduce the volatility of SPMO compared to the one of QQQ, for example. In fact, SPMO has a beta of 0.94, while QQQ 1.11. Beta basically shows a lower volatility than the market when the value is lower than 1, and a higher volatility than the market when the value is higher. One thing that sets SPMO apart, and is certainly a good reason why the volatility is so low, is that through the 2 yearly rebalances, it manages to move fast from companies and sectors that are performing badly to ones that are performing well. In 2022, for example, when tech stocks started crashing, this fund reduced their weight and pivoted hard into energy. Just like that. And when tech made a comeback in 2023, it shifted right back. So if a group of stocks start losing momentum, the advantage with SPMO is that it gets kicked out at the next rebalance. Looking at the top 10 holdings, you see that they tend to be similar in the three funds. But you see that SPMO contains customer discretionary and staples companies like Walmart and Costco, as well as financials like JP Morgan Chase, while QQQ and the S&P 500 are dominated by tech in the top 10. Now I want to get back to the momentum factor and why this can be a great thing for an ETF, but also a disadvantage in particular moments. Big institutions and hedge funds often break down stock performance into factors, patterns that historically delivered above average returns: market risk, size, value, profitability, and momentum. The momentum factor simply says, stocks that have gone up recently tend to keep going up, at least in the short to medium term. That's what this ETF is trying to harness. Momentum tends to shine in bull markets. When trends are strong, it rides them. That's why momentum strategies often outperform during rallies. But when the market gets choppy or changes direction fast, momentum can also lag, because the strategy is always looking in the rearview mirror. It's based on what has worked, not what will work. So yes, momentum works until it doesn't. The advantage in SPMO is that it rebalances twice a year. So I don't know exactly if we will keep overperforming over the long term, but for sure, quick rebalances are a prerogative if you want to invest in a momentum ETF. Because when the momentum is gone, the drop in price is quite quick, and you need an ETF that doesn't wait 1 year or multiple years before noticing the mistake and readjusting. That's why if some of you are Europeans and would like to know what's the European alternative of SPMO, I have to say that not only there is not a direct alternative, but in general, whatever momentum ETF you want to invest in, you should always check how often it rebalances. Some people say that the European version of SPMO is the Invesco S&P 500 QVM UCITS ETF. But it's not exactly true because QVM stands for quality, value, and momentum. Not only momentum. It might be an advantage though, since focusing on momentum alone is not always a good idea. So, is this momentum ETF worth it? We've seen that SPMO has delivered solid returns in the past 10 years, recently even higher than QQQ. So we can't say it's not a good ETF. We've also seen that at least in the past 10 years, it showed less volatility than QQQ, and this is mostly because of the quick rebalances and the fact that strong momentum companies have kept their momentum for over 10 years now. So if you believe in the power of trends, if you're okay with some turnover, and if you want an ETF that actively hunts winners inside the S&P 500, then yes, SPMO could be a strong addition to your portfolio. For me personally, I like it as a satellite position, but I don't have it because I'm a QQQ fan. Still, I believe SPMO has a wonderful potential, and since it has a low expense ratio, I wouldn't see it as a mistake if you decided to invest in it and see how it performs in the future compared to QQQ. And now, I want to hear from you. Did you know momentum ETFs before, and would you ever invest in an ETF like this? Or do you think that chasing winners is a dangerous game? Drop your thoughts in the comments, I always read them and I try to reply to everybody. And if you haven't done it so far, be nice and drop a like to this video and subscribe to the channel to support me. By the way, if you like ETF comparisons, you absolutely need to see this one. Don't miss it. In fact, just click on it and I'll see you there. Ciao!